when the general public finally realizes that it's not the price of eggs or the price of coffee or whatever going up, but actually the purchasing power of their currency going down, then the currency is doomed.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi there, my name is Shane Moran and I'll be your host for this Christmas episode of our last episode of Live from the Vault for 2024 as we welcome in 2025. So welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him pull back the curtain, we will be joined by a returning guest and by popular demand by you, the Live from the Vault community, Alasdair Macleod of GATA, the Gold Antitrust Committee. And that's right, Alasdair Macleod is in the vault, and you're not going to want to miss a word of this conversation. So just before we introduce our featured guest here and head over to the UK, please help keep spreading the word about this channel by hitting that like button right there. Share this information so more people can find out about the channel, and subscribe if you haven't already done so. And if you hit that bell, the little black bell there will notify you as each episode goes live. So for those who haven't already heard of Alasdair Macleod, let me tell you a little bit about him. He's with GATA, the Gold Antitrust Action Committee, and he's a gold money contributor. And he started his career back as a stockbroker in London, England, of course, on the stock exchange in 1970. And he subsequently, he's been an investment manager, an executive, director of an offshore bank in Guernsey, and he has a Substack that you can visit. We're going to put the link below, and you can also visit www.gata.org. That's www.gata.org. And we'll include all the links, like I said, below. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our featured guest, Alasdair Macleod. Over to you, Andy.
Well, Alastair, thank you very much for joining us on this last episode of 2024, hence the Christmas jumper, which I'm very proudly wearing here. I realize that's not really a stock market gentleman's attire, so we'll forgive you in your usual garb.
Yeah, I have to say the waiters in the stock exchange would not permit you to enter in that.
No, and they'd be forced a tie on you at the very least, and that would look a bit odd.
Exactly. Actually, I mean, with a jacket, it wouldn't have been acceptable either in those days. But we've moved on. We have a more modern world now.
Goodness me, that's look, Alastair. This is brilliant. I tell you what, we started the year, one of our early 2024 episodes. What you did, you made a very early call that 2024 was shaping up to be the year when the dollar losses loses complete global credibility, and then you sort of said, well, obviously contain that to when valued in real legal money, that is, which is only gold now. So I'd say what an excellent call that was, Alastair. Can you expand now on really what you're seeing now as we end this year? I'm not going to ask you to forecast the next year, but just basically, you made a great call. We're now at the end of the year. This is our last episode of the year, and I certainly wanted to give you credit for actually taking that stand. And when there's a lot of people really looking the other way.
Yeah. I had one or two friends, not very many, in the LBMA, and I was talking with one of them some time ago, and he admitted that he never ever looks at economic factors. He doesn't understand, sort of money, all that sort of stuff. I mean, he just trades the stuff, and he was making some pretty good forecasts on the basis of his experience as a trader. but I think this is really what it's about. We're moving from the days when, you could just trade gold. If you're a bullion bank, you're probably running a short book. So what you do is, you trade it, and every now and then the punters, hedge funds get a bit overextended. You can bang it and trigger all the stops and get your position back and all the rest of it. That's not happening now. And I think that's the big difference. And the reason it's not happening is because there are bigger forces at play. I think it's probably surprised a lot of people that despite the price rise, the Chinese are continuing to buy. And so are other central banks. So what's all this about? Well, the answer is quite simple. And that is, it's not gold going up, it's paper currencies going down. And this is very, very important. It's very important to get this message early, because when the general public finally realizes that it's not the price of eggs or the price of coffee or whatever going up, but actually the purchasing power of their currency going down, then the currency is doomed. And when the general public wakes up to it, I can tell you the dollar, sterling, euro, yen will all be a lot lower. Now, I put it that way rather than saying gold is going to be a lot higher, because if you think as an investor, you look at gold and you think gold's gone up. As we talk, I don't know what it'll be when this is released, but as we talk, it's had a good day. I see it's up $18. It's currently trading at 2,712. Challenging the levels we saw, sort of 4 weeks ago. If it breaks that, then it's going to go and hit new highs and so on. But do we really want to pay this much for gold? Perhaps we should hang on and wait for a decent shakeout. It's gone too far. But the point they miss is it's not gold going up. It's the currencies going down. Now, obviously, nothing goes down in a straight line or in an even tempo. But I think if you understand that, then you understand that really what your strategy should be is not trading it, but actually accumulating it, and accumulating the physical, not paper. Now, this is a very, very important point. And of course, the whole of the investment industry has a difficulty here because gold is not a regulated investment. So how do you get it past your compliance officer? Well, the answer is you go out and buy ETFs. But your problem with the ETF is you don't own the gold. And worse than that, not only do you not own the gold, you don't actually own the shares in the ETFs unless you have specifically decided to take delivery of certificates. Now, this is a very important point, because the owner of, or if you like, the owner of the certificates, in effect, is, the clearinghouse, the intermediary, the big boys in the middle, basically, who guarantee settlement, Euroclear, whatever. And why have they got it? Well, the answer is quite simple. You've got a huge, great derivative mountain, which is absolutely enormous. And the fear is that at some stage we get a crisis and that could be jeopardized. So what they want is they want your stock to have as collateral to deliver in order to ensure that that whole mountain of deliveries of derivatives doesn't collapse. So, ETFs don't get you out of it. The answer basically, I'm afraid, is you've got to accumulate coin and bars, both gold and silver. Silver I regard as gold on steroids, because the gold-silver ratio is just crazy. At 85 or something as we speak. This is nonsensical. I don't see it going back down to the sort of 15, 16, if you like, when when silver was treated or valued as money. I don't think we're going to get there. But these levels on the ratio are just absolutely crazy. And as gold goes up, silver will go up twice as fast to bring that ratio down to something which is, if you like, more sensible. So I think, 2024 was interesting. 2025 is going to get even more interesting, I think. And I would see these currencies, the fiat currencies, going down in 2025, at least as much as they've gone down in terms of their purchasing power, measured against real money, which is gold. And there are other problems in the background. And I think one thing that could really drive this very, very hard is the debt mountains that governments have. If you look at the G7, there's only one of the G7 which doesn't have a debt to GDP ratio of around about 100% or more, and that's Germany. And they've got their own set of problems. And the theme that I've really been trying to get people to understand is the dangers of this. We have a new president in America starting January sometime, mid-January. And he's made it quite clear, and his nominated Treasury Secretary has also made it quite clear that the strategy basically is to try and cut income taxes, corporation taxes, and make up the shortfall through tariffs, through trade tariffs. Now, this to me is ringing huge alarm bells, because the comparison, I think, has got to be with the Smoot-Hawley Tariff Act of 1930. But it's worse than that. I mean, it's, the whole thing is a bit piecemeal. The idea that the president is actually going to set the tariffs rather than Congress setting the tariffs, if you like. But this time round, of course, we're moving from a point where everything has been internationalized. You've got supply chains going everywhere. I mean, look at Microsoft. When you have your iPad or whatever, I mean, the design is done in California. Fine. And the packaging is done in California, perhaps, or it's designed in California, but all the rest is done in Asia. This is going to be incredibly disruptive. And there are so many aspects of this that what it'll do is when you start pushing up tariffs, Trump said he's going to put 100% tariffs on BRICS members, if they start talking about a new currency replacing the dollar. I mean, well, we've got to treat that as a bit of a joke. But you can see that what would happen is that those countries under that policy would merely reply with their own tariffs against America. And who would really suffer? Well, I mean, the answer is, and this was the lesson of Smoot-Hawley, that global economy suffers. And in this case, we're particularly talking about the Western alliance, if you like, America, Europe, UK, Japan, Australia, God bless them, where I've just come back from. This is a very serious thing. So what does that do to the budget deficit in America? Well, the answer is it drives it up. So instead of having a deficit of 2 trillion under these policies, you're going to have a shortfall of taxes because you've got a slump. I mean, I'm going to mince no words on this. It's going to be a slump if that happens. And at the same time, of course, all the welfare obligations are far greater than anything we've had in the past. So that deficit, I mean, I think it's looking like 3 trillion bid, if I can use dealers' terminology. That is destructive of the dollar, particularly when no foreigners are really all that interested in buying new debt, and certainly not at these levels. So that drives up interest rates. So you drive up interest rates while the economy is tanking with all that debt to GDP. I mean, it's a disaster, a complete disaster. And there is another point, Andy, which about bubbles. I mean, the thing about a bubble is that very few people actually understand they're in a bubble. We are in a bubble. I mean, this has been a rolling bubble. The joke has been we kick the can down the road. They've been doing that since the 1980s. So each bubble feeds into the next one, and it gets bigger and bigger and bigger. And of course, that's what the symptom of all this debt is. And consequently, we're sitting here on the biggest bubble, credit bubble, in history. And it's going to burst. And it's going to burst with higher interest rates when the whole thing starts toppling down. That is what we're going to see in 2025. And the Fed is going to be powerless in this. I mean, the Fed's response every time has been to lower interest rates when things start looking like they're falling apart, like the great financial crisis back in 2008-9, like following the dot-com crisis, when Greenspan reduced interest rates. I think he reduced the Fed funds down to about 1% or whatever. We've had a number of mini crises since, but, basically zero interest rates, that's as low as it can go. It can't go any lower than that. And so how are they going to deal with this bubble bursting? Well, the answer is that it's going to be very, very messy, particularly when all the central banks are in negative equity. I mean, with the honourable exception of the Bank of England, because they push the cost onto the Treasury. But they really are in negative equity, and they are meant to be the lenders of last resort. They are meant to be the institutions who will rescue a failing commercial banking system, and they're all bust themselves. I mean, where this translates quite simply is a collapse in the purchasing power of these fiat currencies, which is why you should own gold.
Well, I mean, you've put a lot of very good pieces together there that all interconnects, as you say, Alastair. It all interconnects. So, I mean, essentially, you talked about a couple of things there which really strike a chord with me. Now, I think when we've both been following Basel III and the revaluation of gold being recategorized as a first asset class on the 1st of January 2023, how the Bank of International Settlements cleared all their debts ahead of that. It was kind of a splitting point between the Fed, who's trying to defend a unipolar dollar, and the rest of the global world, really going long gold, including the Bank of International Settlements. Now, what was interesting is you talked about compliance. Well, one of the big feedbacks I get, and I've got very good connections with first-tier liquidity providers, and also have a good contact at one of the major banks. They better not. I don't want to mention their name because they'll get in trouble. But essentially, have a really good relationship with some of these guys. And what it became clear is that very moment that happened. Talk about compliance. Compliance departments came in and said, right, we've experienced bid-only markets in 2020, in March 2020. When the COVID crisis hit, that happened to be a wholly different event. But nevertheless, we saw a bid-only market. We saw an asymmetric trade getting blown to bits. So what happened was compliance was literally doing exactly what you're talking about. They said, right, we don't want you making markets between a 96% leverage undeliverable COMEX contract and an NSFR compliant deliverable FX market. Now you've got to provide. You now have to be back all your spot FX positions with physical gold if they're demanded. And now you've got this backdoor of the COMEX, which is dealing with 96% leveraged, unbacked, paper-backed, naked short-backed, whatever you call it. 4% backing to me is unbacked. And of course they were then, so what happened was the market making, all the legacy market makers withdrew from providing liquidity to between those two divergent risky markets. It's too risky. So, and that's evolved over time to the point now when we all look at open interest. I know you follow open interest. You track it very, very granularly. But the component of the open interest is evidencing an outflow of real speculative liquidity into the physical markets, because the market makers, banks, don't want to make markets anymore. So they've withdrawn from doing that. And now they're making physical markets, and they're complying with what's going on in the Asian facing markets where a physical price is being determined. So I just think it's really interesting. You talked about compliance. So many people don't get the massive change that this is just one of the many changes that changed the structure of where you could game. Obviously, the COMEX was created over 50 odd years ago. One of the primary goals of that was after gold was after Nixon took gold off the gold standard, dollar off the gold standard. So essentially, you need to bring something in to dilute the price and stop people converting their dollars into gold. So basically, that game is done, and I think people don't understand that game's done. And so, just your thoughts, please.
Well, it's interesting because I mean, we'll have both noticed that this market, the futures market, which is meant to sort of coincide at the end of a contract with the physical market. Not that it should lead to any sort of interaction between the two markets, but it sort of ties the two together. What we're finding, however, is that it's now the futures are now a vehicle for taking delivery. And now I don't know that the delivery necessarily is going out of the COMEX vaults, but I mean, the expiry of this December contract has seen huge amounts of gold delivered. I think something like 60 odd tons. I mean, I haven't totaled it up quite, but since Thanksgiving, I mean, it has been an enormous amount. And I think something like over 1,000 tons of silver as well. So I mean, you're right. I think the character of the market has changed very much. I mean, you'd be a lot closer to these changes than I am, because I'm standing from the outside, more or less observing, the information I'm given. But when these bullion banks sort of try and protect themselves, I think most of the time they're protecting themselves with paper. Like they will sort of take out of the money call options just in case the price rises too far. But, we come back to this derivative situation. If you get counterparties beginning to fail or having to be rescued, then I'm not too sure that out of the money call options are actually any protection at all. I mean, I don't know to what extent the bullion banks have been doing this. Do you have a view, Andy?
Well, I think that yes, on the speculative side, but they really are. And this is it, that they're no longer, if you're not making the market anymore, and certainly, but we do know that obviously that nobody can deny the fact that there is market manipulation. So what we're seeing is these legacy market making bullion banks who've withdrawn from making liquidity, unless they're protected by the Fed, they obviously act as agent for the Fed. The bullion banks that have a privilege to have gold accounts with the Bank of England. And there is a capping element to the Fed is definitely against or trying to maintain or put a cap or restrict the veracity of how many dollars it takes to buy an ounce of gold as opposed to gold rising. But I think so we see them. Yes, of course, when you're privileged with that insider information as to, well, you've been told that this is where you want the price, this is try and cap it. Well, clearly that gives you such an enormous advantage. So you might want to play some paper games around that. But essentially, I think it's gone. It's gone other than a little bit of speculation on the side. The Fed definitely guarantees any losses from these banks who are all long for their own book. Why would they even dare? Why would they? They're not allowed to. Compliance says no. So to answer your question, really, it is definitely more on the sidelines, a little bit of insider information around non-farm payrolls, which they probably know 2 days ahead, and that kind of stuff. So, yeah, I think other than that, they're really out.
That's interesting because what the implications of what you're saying is that the market is getting less liquid. I mean, significantly so. And there is another aspect I've noticed on COMEX, and that is that the mining, the mines, they're not hedging it. They're not hedging forward production as much as they have done in the past. And this, of course, throws the onus on the swaps, who are the other side of it. And, unless they've actually got physical sort of tucked away somewhere, they can't actually cut their short positions down at all. I mean, it's just stubbornly refusing to go lower. So it's a tricky thing. And I think what we're seeing, to develop what you were saying about, which sort of implies that liquidity is drying up in the futures markets, what we're beginning to see, I think, is a bear squeeze on the system. And that has got interesting implications. But, I think, the root of all this, basically, is that this gold is just still disappearing from here and going into firm Asian hands. I think that, the sort of the whole of the BRICS thing and all the rest of it, that's going to die down because I think I'm right in saying that Brazil is the new chairman. But so what will happen is that you won't get much on the headlines. I understand that Lula has got he's having surgery on his brain because he had a hemorrhage from a fall. I can't see the Brazilians doing an awful lot, but I'm sure that the Russians and the Chinese in the background will continue the good work, I put that in inverted commas, which they did particularly under the Russian presidency, which is, has got another 2 weeks to run. So, that side of it, I think, is going to quieten down. But this doesn't mean to say that selling of the dollar in return for gold is going to die down as well. I think that can easily accelerate. The thing that's fascinating is if you look at the psychology in the market, there is virtually no bullishness in the West. Apart from obviously the odd punter in the futures market who thinks, he sees a momentum and he buys the momentum. He's clueless really on that. Or he's just doing a pairs trade. He's looking at dollar versus gold and gold versus dollar. He doesn't, he's not interested in taking delivery. He's just got a leverage play against one or the other, and he doesn't actually care which. That is the way a trader works, which is absolutely fine. But other than that, I don't think there is anyone really, apart from a few oddballs like you and me, who actually understand what's happening to the currencies and therefore what is going to be reflected in the gold price and why you should hold gold. Buy gold, and stack it. We know this because the gold is going out into Asia. It's going into the central banks. It's going into I think, sort of, if you like, the government wealth funds in Asia. I can see that that's quite a lot of where the Chinese stuff is going. You've got the Chinese people, too, who can't actually rush out and buy dollars or whatever to hedge their own currency. Yeah. And, interest rates are tending to drift lower in China as a matter of policy. So, everywhere there's gold accounts, and you've got gold accounts in Russia as well. You can open a gold account at the bank. But the thing is that these guys actually cover their positions. They don't run fractional reserve, as we would call it. They don't run these leverage positions or uncovered obligations. So they cover them. And so there is enormous demand amongst people who are frightened of the West and what they're doing to currencies. But that does not include our populations. They've yet to buy it. And, this tells me that the sentiment, if you like, in bullion markets is still immensely bearish. Because, I'm not saying bearish in the sense that people are shorting it. No, of course they're not. But they're just completely disregarding it. They're disregarding the messages that are coming out of the bullion market. They may not understand the messages. I can understand that. But they're not even trying to think, perhaps this is something we better find out about. They're not even at that stage. And the average ownership of gold or gold substitutes, whether it's mines or ETFs or whatever, is still a tiny part of everyone's portfolio. And of course, this is another thing. Once you get the switch out of the Nvidias of this world, which will happen because that's where the bubble is, then where does it go? Well, a lot of it gets destroyed, let's face it, because the markdowns are going to be sudden and severe. But what is left over is going to go into mines and ETFs and to a lesser extent, physical gold. So, this I think it feels to me, speaking as an old broken stockbroker, it feels to me like this is very, very early in the game. And this game, I don't know how long it's going to run, but I suspect an awful lot of people are just going to miss it entirely. And they will realize once they learn, they discover that actually what's happening is their currencies are going down, not prices going up.
That's so interesting, Alastair. Yeah, that's absolutely bang on. And I think what tells us there is stress in this paper to physical battle is now, and you've probably seen it. I mean, it actually makes me laugh. The CME is now going to launch a 1 ounce unbacked, margined contract which cannot be delivered, has nothing behind it. There's not even an EFP backdoor to deliver it. So what amazes me is I mean, this is bullish for gold, because I mean, they're actually putting a lot behind this, because the open interest has vanished, liquidity is vanishing. So they think, oh, why don't we go after, oh yeah, look at those Asian guys. They buy a lot of gold. But the CME, because it's lost pricing power, it's attempting to attract retail demand from Asia. But our experience tells us these savvy buyers have a generational respect for gold and as money. And notwithstanding that putting weaponized dollars at risk as well, I mean, Asian buyers are not going to trust this self-regulated CME, completely unbacked fiat gold scam. I think it's going to fail miserably, but it just tells me the desperation level.
It's fascinating because one of my subscribers on Substack asked me the question, what do you think of this thing? And I must admit, I was lost for words. I couldn't really think of a sensible reply because it was so nonsensical. It didn't seem to me that it was aimed at the Asian guys, really. I think it was really aimed, if you like, in an American context, I think, to an American market where, I mean, I think it's even too soon to say that there are early signs of retail interest. They're not really. I mean, there's some maybe, but it's not really that even. And I mean, as far as the Chinese are concerned, I mean, if they're going to punt, they'd punt on Globex. I mean, I suppose some of the smaller punters may go for some of the mini contracts, but and they are wild punters. They really are. That there is no doubt. But I think there's the bigger play is something which we should be very much aware of, and that is that Chinese citizens save something like, households save something like 35% of their earnings. Now, 35% of their earnings is roughly $2 trillion. Now, that is going into bank accounts, property. Oh, no, not property anymore. The Shanghai Stock Exchange, well, a little bit maybe, but, that's not so much. But then there's gold. And so, we can see that this demand is continuing and continuing and continuing, particularly since Chinese nationals do not have access to foreign currencies to hedge out of their own currency. So, even if they don't understand the gold story, okay, they've got a predilection for gold, but even if they don't really understand the story, those who want to hedge out of their own currency are forced into gold or, to an extent, I suppose, silver as well, but particularly gold. So I think this is the beginning of the story. And, sort of concerning your question about the outlook really for next year, I think that these currencies, our currencies, have got a very rough time, which will be reflected in a far higher gold price by the end of the year. And that is without geopolitical events. I mean, that's another subject which, perhaps we can sort of touch on because, President Trump reckoned he could get peace in the Ukraine in one day. I mean, dream on. There is absolutely no way. I mean, he's appointed some pretty neocon types, if you like, on his, the sort of homeland security, the defense, and the intelligence services. I think that the Russian demands are going to be very, very simple. The bare minimum will be they keep the Eastern Oblasts and Crimea, and they have cast iron guarantees that the rest of Ukraine will not join NATO and remain completely neutral. Now, I don't know how that later guarantee can be given. I don't know how the establishment in America, the neocons and all the rest of it, would accept that. I think they would probably, this is not going to be resolved in a day. It's going to be resolved on the battlefield, I'm sorry to say.
Yeah.
And here's an interesting thing. We've sort of took out sanctions, both financial and, goods and services against Russia. Well, I'd wrote an article on the Russian economy the other day. It was prompted really by, sort of journalists in this country and elsewhere, saying that the economy is doomed and all the rest of it. I'm talking about the Russian economy, not our own. The Russians are doomed and all the rest of it. And I looked at this, this is actually completely wrong. And here's some key figures. On a purchasing power parity basis, Russia is now the 4th largest economy in the world. Did you know that?
No, to be honest, Alastair, I didn't. I hasn't clocked that.
No, and it's gained this position. You might say, despite sanctions. I would say, aided by sanctions, in a sense.
Yeah.
And if you dig into the pile a little more, you see that inflation is running at about 8%. It's probably going to rise a bit now. It's a statistical thing, stuff drops out the back end and all the rest of it. It's running about 8%, it's probably 10%. But wage settlements have been running at more than twice that. Now the difference, unlike us Anglo-Saxons who go out and spend it in the pub, what they're doing, they feel wealthy, but they're saving it because the banks are paying 18% on deposits. Unlike our banks, if they see, if the Bank of England raised interest rates to say 15% or something like that, our banks would probably still pay 0.5% on a deposit. So, but the Russian banks are actually quite healthy, and they are paying good interest. The result is that this wage inflation is making everybody feel a lot better off, but it's not leading to consumer price inflation in the same way. There was another thing. I was looking at Putin's finances. Let's call it that. The government's finances. Earlier this year, everybody was talking about debt to GDP, government debt to GDP, rising from around about 18% to around about 22% as a result of the war effort. Well, the budget came out and it was moderately in surplus. The result is the debt to GDP is around about 18%. Now that compares with America at about 130%, us at a little over 100%, France at 110 going on 120%, Italy 140 to 160%, Japan 270 odd %. This is a country actually in pretty good nick. I think that, the one thing I do really think, having looked at all these numbers, is that Russia could go on a gold standard tomorrow. And it's got enough gold, if you like, in government hands. Not just in the hands of the central bank, but also in sovereign wealth funds. And I'm told that the sovereign wealth funds have something like 10,000 tons of gold between them. That's an estimate which has come from sort of quasi-intelligent sources, if you like.
Yeah.
So you're looking at Russia's got around about 12,000 tons. Now, the point behind this is that if they went on to a gold standard, and I mean a proper gold standard, whereby rubles were exchangeable for gold at the central bank or at the treasury, whatever, it doesn't matter, the issuer, if you like, of the currency, then the currency becomes a gold substitute. It is as good as gold, if you like. So what that means is that Russian banks can go into the West, take our gold, which yields a lease rate of less than 2%, push it into the Central Bank of Asia, get 18%. What an arbitrage.
Amazing. Yeah.
So this is, the point behind this is that the true purpose of interest rates is to manage your gold reserves. It's not to manage the economy. It's to manage the gold reserves. And of course, by implication, manage the exchange rate, or to guarantee the exchange rate. And this is the problem that Russia has. Nobody wants to buy the ruble. I mean, at the moment, it's sort of collapsed back down to 105 to the dollar. Yeah. But nobody wants to buy the ruble. Who in their right minds would buy the ruble? The fact is, nobody's got any rubles, so they could actually bang it up quite quickly. But, the other big question is, at what level should they fix it, sort of thing? I mean, the answer is at the prevailing rate. The idea that you sort of look at the total quantity of rubles in circulation and, take your gold reserves and divide the former by the latter, and that gives you a price. Nonsense, absolute nonsense. What they can do, quite simply, is with what they've got, they can start with that, and they can lower the interest rates while the gold comes in, if you like, to a level where there is some sort of equilibrium. And I think that what that means is that you would have interest rates in Russia eventually running at less than 5%, and price stability. As another aspect of this, I mean, people would say, well, it's, you got to look at what's happening to commodity prices and all the rest of it. Yeah, okay. Well, if you look at the price of oil measured in gold, it is at roughly 60% of where it was in the 1950s. Mm-hmm. In other words, the relationship between oil and gold has become expensive because we're all getting frightened, or at least in Asia, they're getting frightened of currencies. Oil has become expensive relative to gold. Therefore, Russia's main exports basically mean that the gold price is actually pretty good on an economic basis. So, putting the whole thing together, why doesn't Russia go on a gold standard? And I think that the answer to that is that they realize that they would collapse the entire Western financial system if they did that. So that's one which they've got in the background if the Americans get really nasty. I think more likely both China and Russia are of the view that they need to protect themselves from the fallout of a collapsing dollar. So if we see this year that sort of dollar crisis coming, then the likelihood of China and Russia going onto a gold standard just to protect their own currencies, I think will increase immeasurably.
Yeah, and I think that kind of leads perfectly into, and you did mention it, we talked about Trump's BRICS 100% tariff threat. And obviously, as you say, while this is probably just posturing to come in with a strong hand, I mean, which is probably what this is really all about. But really, cutting to the quick, and I think further weaponizing the dollar, essentially what you're doing, is extremely bullish for gold. Because, I mean, I think a lot of people forget Russia is an energy and agricultural superpower. So existing sanctions already necessitate ongoing settlements to utilize national currencies. So unless Trump removes, the unlikely event that Trump removes the main sanctions on Russia, these non-dollar BRICS pay settlements are just going to simply expand. And because it's possible, as you say, that's I think you've just described the absolute fallback position. Should they don't want to destroy the global economy, but should there be a problem, it is their financial nuclear weapon, I would have thought.
Absolutely. And I've used that description before as well. And I think, the way we've got to look at it, I think, is that the world is sort of bifurcating. You've got, us old boys in one corner, and you've got the new boys in the other. And we are actually outnumbered by, the sort of, if you like, the Asian hegemons and their BRICS followers and the associates of BRICS now, a new category. For those who are sitting on the fence and, perhaps don't feel that they could really comply with everything quite so quickly. We're looking at over 60, almost 70% of the world's population in that camp. and it will be rapidly industrializing. And this is where China is so much better than us, because we've always taken the view, I mean, particularly back in the Cold War days, that we just buy the politicians, pay them off, make sure that they've got their pockets full of cash, Swiss bank accounts, and all the rest of it, and they will stay with us. And we've never really gone from that mentality. I mean, we have in this country, it's sort of evolved slightly, if you like, into we will support the poor people in these countries, which basically means we give money to the politicians on the theory that they will use it wisely. But we know what happens. But China has a very different approach. China, where, let's say, with somewhere like Angola, imports oil from Angola. Okay, it has a trade deficit with Angola. Angola has the surplus. So it sells goods back. And on top of that, it actually invests in the country so that it balances things out that way. It's the mixture of trade and capital flows. And this is so much more sensible. And while I can tell you that, the sort of Africans in Africa don't particularly like the Chinese because it's a completely different world as far as they're concerned. And not only that, but when the Chinese are running an operation like, building an infrastructure or something like that, I mean, they are the bosses, and, they're telling you, jump the way I want you to jump. And that's never quite popular. But in terms of developing these countries, what will follow, I think, is the sort of industrial revolution which we had in this country in the 19th century. And you don't need a fiat currency for that. If anything, if you have currency stability in the form of, let's say, linking your currency firmly to gold, then all to the better, because it means that anybody, investing, let us say, in production or, a new mine or whatever, has got certainty in his economic calculations. That is the important point. And not only that, but if you introduce stability into these currencies, I can tell you, the Africans will save. At the moment, they don't have that ability because their currencies are all trash. So moving on to a gold standard, I think, is a very important part of the entire Shanghai Cooperation Organization and BRICS plan. They've got to move in that way in order for their plans actually to deliver. And so that, I think, is where we're going. And not only that, but we can see that if we look at our currencies, I mean, we were talking about debt to GDP and all the rest of it a little earlier. I mean, they are on their last legs. I mean, in terms of how long have they got to survive? I don't know, 6 months, 1 year, 5 years? I've got no idea how long it'll take for them to collapse and for a new phoenix to arise from the ashes, whatever that may be. I mean, we'll get it wrong, let's face it. We'll get it wrong before we get it right. But as far as the rest of the world is concerned, they can carry on without us. They really can. I mean, people say that China is so beholden to America for her exports and all the rest of it. No, she's now exporting more to BRICS nations than she is to America. She's actually weaned herself substantially away from depending on American trade. Yeah, so this world is changing, and I think these are the changes that are going to become a lot more obvious in 2025, even though on the surface, I think the sort of BRICS thing is going to sort of appear to quieten down. I mean, with Brazil in charge and all the rest of it, I just think that the development is, if you like, going to be behind the scenes rather than up front in the newspapers.
And of course, what we're witnessing currently, and you can just look at any medium-term chart, what we're seeing is a buy-stealth gold price revaluation happening under our noses. And people are thinking it's an event. It's a process. And I think, so those people that have been waiting on the sidelines, like you say, well, we need a pullback. Well, you're going to miss the boat, because it is simply, and you only have to look back and think, well, hang on, at $2,000, everyone was saying 2,000 is too expensive. It's going to crash. And in fact, I think that was a huge misstep by the Fed when they breached that level and triggered massive central bank demand at that level, waiting at that level. And then ever since then, we've seen what is essentially every single, all of these BRICS members and potential BRICS members, these that have national currencies, have also been investing in gold, because the more gold you buy, the better you can value your own foreign exchange currency against another imbalanced. I mean, these are all imbalanced currencies, but the more gold you have, as you've just outlined more succinctly than me, the more gold you have to back up each FX currency of these nations, the easier it is to value a commodity for a trade between yourselves. And this is what's happening. And this is why, who's waiting for this pullback? It's not going to happen.
No, it's not. It's not going to happen. And I mean, the psychology is, look, we've missed it, so forget it.
Yeah.
I've been there. I got the T-shirt for many, many years. One of the jokes about stockbroking is, how do you make a fortune? How do you make a large fortune? Give a small one to give a large one to a stockbroker, and you make a small fortune. He'll deal with it for you. Lose it all. But no, I think the psychology of it in the West, we are so far behind. We really are. And if you look at the mining sector too, they are. I mean, there are mines which are so incredibly cheap. If you have half an understanding of the potential for the relationship between fiat currencies and gold, and of course, the institutions will switch quite rapidly out of the sort of tech stocks and all the rest of it when that bubble goes, and they'll be walking into trying to find mines. And how many analysts do they have now? I mean, there are very few actually good analysts. I mean, brokers haven't invested in analyzing and covering the mining sector. It's a dirty business and all the rest of it. And anyway, it's been dead for Christ knows how long. Why chuck good money after bad has been the approach. And so I can see that there's going to be some very, very big shifts, if you like, in the entire investment scene in 2025. It's very interesting times, I think, very interesting. I mean, interesting in the sense that, we'll be watching, it's rather like a public execution. You'll be watching people dangling on an end of a rope, sort of speculating how long they're going to be twitching, sort of thinking, hold on, this could happen to me. There's a sort of that sort of feeling, watching these developments. For those of us who have, if you like, an understanding of the relationship between money and credit, this is actually a very, very serious junction.
And I think one of the things that sometimes things really stand out with you, with one, and obviously we saw the World Gold Council talking about advising Swiss pension companies to sell US Treasuries for gold. But what really struck me was a Bloomberg interview I saw 2 weeks ago, I think it was, and it was the head of UBS Investments, and he manages 1.7 trillion. And he said, yes, I recommend selling US Treasuries for physical gold. And we didn't say physical gold, but he said gold, and I'm assuming it's physical gold.
Unallocated accounts, probably.
Yeah. And so I thought, well, hang on. All of these things going on. And now we're seeing the selling of US Treasuries. But Alastair, I mean, at what price? With the amount of debt being created, this enormous bubble, at what price is someone incentivized to buy US Treasuries?
Well, yes. I mean, it's a very good point, because, at the margin, it is foreigners who basically will make the price. And we know that China is a net seller. We know that the Japanese are also net sellers. I mean, and that's not a government thing. That's private sector, pension funds, insurance companies, and so on. All the sort of attempts, if you like, to issue long-dated treasuries basically have met with very lukewarm demand. The the way in which the US Treasury has been funding itself is essentially through Treasury bills. And so the maturity profile of the debt is shortening and shortening and shortening. And this is actually quite a dangerous situation. I've said this in other interviews. I remember in 1976 when the IMF were called in, when we had a similar debt situation, not nearly as much as we have at the moment, not nearly as bad. But we had a socialist government. Yeah, well, we got another one. Things, we had Dennis Healy, who was going to squeeze the rich until the pips squeak. I don't know if you remember that one.
I do. Yeah.
And the whole situation deteriorated so much that, first of all, the Americans came in and supported sterling because that was threatening to break 1-to-1. And so they bought sterling, squeezed it up, helped it a bit. And the quid pro quo was that, one of the American government departments called the IMF were deputed to come in and force the British cabinet into taking action, cutting spending, balancing the books and all the rest of it. And as part of that, I remember gilt issues. There were 3 gilt issues. One of 15% coupon, 15.25, and I particularly remember the 15.5s of 98 because I think I subscribed for those. So now that's what happens when you get the situation we have at the moment. Basically, when you get rising interest rates, when you get rising bond yields, the foreigners aren't going to buy it. If anything, they'll sell it until you raise the rates enough to ensure that they will take a speculative position and buy it. Buy sterling, maybe buy some gilts, whatever. That was the situation back in 76. We have exactly the same dynamics with the US Treasury market today. So, people sort of think, well, they ask me, how high do you see the, bond yields going? Or they think that also the other thing they think is that the Fed's in control of this. It's not. It's not. They just don't understand that money is like any other commodity. There is a price for it, and that price is called the interest rate. Now, if nobody wants to buy your currency, your credit, then you have to raise the interest rate to the point where they do. And as far as the banks are concerned, they're over-leveraged on their balance sheets. So they're not lending out credit either. So that credit, any expansion of the credit has to come at a far higher interest rate to reflect the risk which they would be taking on. These interest rates are going to go higher, and I don't care what the Fed does with its interest rate policy. It's going to go higher because they're in a debt trap. And, I wouldn't sort of guarantee that it'll stop at the 15% that we saw in our country back in the 1970s. And think what that does. It's a situation, this is a point about a debt trap. As the rates go up against you, the situation just gets worse and worse and worse and worse. The Fed, there is only one way in which the Fed can fight this, and that is to replace the lack of buyers for their debt with aggressive quantitative easing. In other words, the Fed becomes the buyer of the entire, Treasury maturity market. Just goes out and buys it, increases its balance sheet. Of course, the other side of that is it floods the economy with cash. What happens to the value of the dollar? It tanks. So, and already, the Fed is as I said earlier, it's already in negative equity from the losses of its previous QE. The whole point about QE is that you end up, you push interest rates down, you push bond yields down, and then you buy them at the top of the market. That's exactly, that is actually an accurate description of monetary policy. And the losses from the last time round are still there. And nobody worries about it because they say, they can print their way out of trouble. Really?
And Alastair, you're right. And the thing is what sometimes, and I remember those interest rates at around 15% in the UK. And what was interesting about that is that, or what was devastating about that really, was that we saw, there was a housing, I know a professional couple living in a huge brand new housing estate in Gloucester. And every single one of those properties went into default. And we're talking about school teachers, professionals. We're not talking about deadbeats here. We're talking about professional people who drive to work and have a job, could no longer pay their mortgages. So the banks all came together and said, well, we're not going to repossess anything because we don't want to market to market. And so the very real side of this is how? I mean, we're talking total collapse here, because those banks go down, the daisy chain collapses, the whole derivative market, 2 quadrillion, what, I don't even know what it is anymore, but the whole thing implodes.
Yeah.
And it's very real. And I think the average person trading the markets right now was probably at university in the 90s. You know, I mean, I'm sorry, but they wouldn't have known anything about this at all.
No. I mean, well, two points there. I mean, the first one, the real crisis in the UK, mortgages were very, very restricted in those days for residential property. So generally, I mean, there were people who got harmed badly in the 70s, but not the majority of people, because the mortgage exposure was pretty low. But what really happened, I remember this so well, in the latter half of 1973, when the Bank of England raised interest rates that October, it crashed the sort of commercial property market, and it took out the secondary banks, all those sort of Kaiser Ullman, Slater Walker, Vavasor, whatever, all these banks went bust, along with property, which became just completely valueless. We've seen a little bit of that this time in America. The commercial real estate market has become pretty unmarketable. And it's hit by two things. First of all, rising interest rates. Now that they've eased off a little bit, there's a sort of slight sigh of relief. But then you've got the working from home thing, which means that office capacity is far too large for the economy. And I've just come back from Australia, and stopping in places like Kuala Lumpur. I mean, you'd be amazed at the amount of excess capacity in property. Tower blocks everywhere. There's a whole new city on the way into KL from the airport. And, you look at this and you sort of think, this is a boom which is going to go bust. So it's not just America, it's everywhere. So, I mean, that I think is a real problem coming up. And then, of course, you've got the zombie companies. I mean, zombie companies are relying on the Fed reducing interest rates back down to something they can afford to pay, which I guess is somewhere less than 2%. That's not going to happen. So companies are going to start going bust. It's not good. And not only that, but I think that what we will see in 2025 is a crash in the equities. Because as soon as interest rates start going up, and I would guess that if you see the yield on the US long bond go over 5%, that will trigger a collapse in a wildly overvalued equity market. And the effect of that is not just the effect on individuals, but we're also looking at collateral for the entire derivative system. And of course, the other thing which is central to this is the derivatives in precious metals. And, if you get anybody getting into trouble there, and it could be because they're counterparties in other markets. I mean, the cross-infection, I think, potential is really quite large. So I'm afraid I'm not a very cheery person to have on, on the Christmas edition of Live from the Vault.
No, but Alastair, what I love about these sessions, this is about education.
Yeah.
And I think what you're bringing forward here is a really insightful view of all of these pieces that you recognize as perhaps making, creating the next path forward, the pitfalls, etc., etc. But it's about education. And it really, the way I look at it, this is for people to take away what they want from it. It's all about, to me, this is about taking the ability to take personal responsibility for your own actions, not to be led by the nose by groups that say, do this, do that, or the other. I mean, what we're doing is really laying out a lot of the pieces of the puzzle. And so I think people should rewind some of this, Alastair, because it's very valuable information. And I think within all of this, and there's certainly some of your views there about how the whole thing fits together. And to me, it's a question of what do we do to protect ourselves from these things that you're talking about. So there's a positive side to this, is that we're listening to you. It's not all swings and roundabouts. It's not all roses, but we need to know what to do. And obviously, you've been a great advocate all the way along. As long as I've known you, physical gold, physical silver, what else do you need to know? It is money, and everything else is, as you say, credit. And I just want to thank you for actually coming along and being a part of our last episode of the year. I think it's nice we had you at the beginning, we've had you at the end. And I think how do people, because I know you have a marvelous product called, it's at Substack, it's your own service. And people that want to get this information on a daily basis, how do they find you, Alastair?
Yeah, I set up a Substack. I'm no longer head of research at Gold Money because, I mean, it's rather preaching to the converted there. I think the education process has to be a lot wider. So I'm concentrating on a Substack. And the objective of it is basically to educate people, as you say. And the education has to include things like understanding the economics, understanding what money is, understanding that credit is not money. And also understanding the factors that influence the relationship between money and credit, which include things like geopolitics, obviously economics, and it involves things like government finances in particular. So that's one aspect of it. The other aspect of it is just to ensure that relevant information, I provide relevant information to subscribers. I'm very, very keen to try and widen this as much as possible, because I feel that I've got a public duty, if you like, to ensure that as many people as possible, as long as they're sort of willing to try and learn, will protect themselves from the inevitable consequences of, bubble after bubble after bubble, all being rolled up into the next one. When that bursts, there's going to be nowhere to hide. And, I think you've got to understand, how serious this is. And as I said earlier, the point about a bubble is that most people don't actually understand they're in a bubble until it bursts. That is what's going to happen. So my Substack is alastairmacleod.substack.com. And if you can't spell my rather Scottish name, just Google MacLeod Finance and it'll take you there. And welcome. There are two categories. You can be free and broadcasts like this, which is sort of in the public domain, I will certainly make available to free subscribers. And as well as that, there's paid subscribers, and they get they get the full information. And on top of that, there's really quite an active chat scene amongst people who I think from people who do know what they're talking about, all the way down to people who don't really understand this and are trying to learn. So that's, I think, another valuable aspect of it.
And of course, we'll provide a link. Of course, we'll provide a link so that it's easy to find you. But I think people, in my view, people should pay for information. I think there's so much free stuff out there. And yes, some of it's valuable, etc. But I mean, who's got the time to do that? I think sometimes in my busy day, and then I'm sure in your busy day and the average person's busy day, you just haven't got time to spend hours looking at stuff. So you have to figure out, where am I going to get it? Where am I going to get it succinctly, quickly? And really, you have to pay for it. And it's as simple as that. And Alastair, you do provide a lot for the money. And I think I really honestly recommend that people do subscribe to you, try your service, figure out if it's working for them. And I strongly suspect they probably will.
Yes. Well, Andrew, thank you very much for the endorsement. Anyone who subscribes, I hope I won't disappoint them.
I doubt that very much, Alastair. But thank you so much. And my Christmas jumper says, well, happy Christmas to everybody.
Happy Christmas.
And I wish everybody a peaceful, relaxing time with your families, a little bit of time off to really catch up with what's really important, which is, as I say, family. But thank you so much, Alastair.
And a golden new year to you too.
Yeah,
no, it's been very much my pleasure. Thank you so much for having me on.
Thank you, Alastair.
All right. Thank you, Andrew Maguire and Alasdair Macleod, for another in-depth discussion. And remember, buy physical. Make sure it's backed 1-to-1 and understand the difference between what Andy affectionately calls the casino gold and silver markets and the actual physical gold and silver markets. They're not the same. Paper and physical, not the same. Don't be fooled. And there you have it. That's all we have for you today. And again, it's our last show of the year, last episode of the year of Live from the Vault. We wish everyone a Merry Christmas. Please help keep spreading the word about this during the holiday season, about this channel, by hitting that like button right there. Share this information, subscribe it. If you hit the bell right there, we'll notify you as each episode goes live. And with that, we'll see you next year in 2025. And for more updates and all of the Live from the Vault information, and we'll see you then. Bye for now.